Howdy. Welcome back to Dion Talk. How to survive the 5 years of suck. The first 5 years, the worst 5 years for most of us, although I guess there are people who fail, so it gets worse. But when you talk to most investors, why do people quit so often in the first 5 years? And to define the 5 years of suck, think of every movie you've ever seen about the military or law enforcement or even college hazing of trial by fire. What did you go through to get where it was worth being? And if you did go through things, were they worth it? In the first 5 years, the hardest thing is you don't have proof of concept. If somebody says, how would you start over? How long would it take to reach financial freedom? It's fairly easy to go, I've done it. I know it works. I know what is a reasonable expectation to have, not a lofty, it's got to work out perfect to work, but in most cases, this is what would happen. It's very easy to say that or to do that. But when you're starting out, like Frank here, those first 5 years, especially with your story of having tried it once before and it didn't work out, not only do you have proof of concept, but you have proof of not working out. Why are those first 5 years so rough? And the way to look at it is we call it the 5 years of suck because it's basically a 10-year journey with real estate to reach financial freedom. You can hear of the Superman stories of people who did it in 2 to 3 years, but an average person can do it in 10 years or less, even if you're not starting from the best position. So to make a 10-year plan, you can be reasonably happy if it happens sooner. But if it doesn't happen sooner and you made a shorter plan, you're more likely to quit. Kind of like with stocks. If you save and invest and put it into stocks, we generally go in thinking compound interest needs to do its thing. There will be years where the stock market can go down, but if you look at over the long enough timeline, the stock market goes up. So our mind sees stocks as a long-term play. With real estate, you can start having cash flow the month after you close on a property. So our brain says, well, it can happen sooner. And we see the examples of people who did it in 2 to 5 years. So in those first 5 years, I asked you a question just before we came on, Frank. If you were investing for 10 years, what do you think your cash flow should be? And right now you started in 2021. So you're coming up on 4 years on some properties. You'll be hitting the 5 years soon. You're still in the 5 years. If you don't mind sharing the numbers, what does your cash flow look like today?
Yeah, we talked about that a second ago. The right now the positive cash flow from we have 10 doors, we have 7 properties for 10 doors, and the positive cash flow should be 2,700 a month.
So the positive cash flow is 2,700. And then we said, so if you're investing for 10 years, what should happen to the cash flow?
My thoughts are that it should double.
Okay. Because your brain thinks like this. You're almost to the halfway point. You're almost to 5 years. So if 2,700 is your cash flow, the 10-year point, you should double it. 27 times 2, 5,400 is 10 years of tenants, toilets, and termites worth $5,700 a month when at 5 years you're making 27. Does 2,700 a month change your entire life? You never have to work again. You can travel anywhere you want.
No, not yet.
No, not yet. So at 2,700, you might not even feel like 10 years will be worth it. This is why so many people quit at the before or at the 5 year mark because the time, energy, and effort it took to get to these 5 years to get you $2,700 a month in cash flow, which is quicker than it got me there. I wasn't at 2,700 a month in cash flow in 5 years. Your mind thinks that these first few years, year one, year two, that section of the chart to the left, in year one, how many rentals did you have?
That first year we just bought one triplex.
So you had one triplex, you had 3 units.
Mhm.
So a $100 a year rent increase could mean $300 a month. Okay. Well, in year five, let's say five now, even though you're not quite there yet, how many units do you have today?
10.
10. So a $100 rent increase could make you $1,000 a month at the 5-year mark. This is why it's so frustrating, is because you're in the first start of this. I use these same charts with uh, Curtis, who said, I'm at the 3-year mark. Why don't I feel like I'm 1/3 of the way to my goal? Because his brain said the same thing yours did, that this is linear. At the halfway point, you want it to be halfway to your goal of what it would be in 10 years. At the 3-year point, I wasn't even making $1,000 a month. So your mind is going to only follow what's actually happening here. You can't see, unless you put it on a chart like this, what hockey stick growth means. The 5 years of suck is in the beginning. You don't have very many levers to pull. You had one triplex. Maybe you could refinance to a better rate. That impacted one mortgage. Maybe you could increase your deductible to lower your insurance premium. That impacted one property. You can do rent increases on all of your tenants. That's 3 tenants. After year 5, when you start getting to the point where you have levers to pull, before you even hit the income snowball at the end, after 5 years, you're far above where I was. The 5-year point, I wasn't even close to 2,700 a month. And so you're doing better than I did. But it goes so much slower than what you expect. It would be very easy to quit when you have $1,285 a month in cash flow. It would be fairly easy to quit $2,700 a month because you have to deal with your property manager. You have to deal with tenants at a distance. You're dealing with evictions and tenant turnover, and it's a lot of stress for $2,700 a month. As a contractor, how many more jobs a month would you have to do to make another $2,700? A couple big ones or 4 or 5 small ones?
Yeah, probably right around there.
Mhm.
Exactly.
So why put up with tenants, toilets, and termites when you can just go do a little bit more work?
Yeah.
Then, when you get past those 5 years, this is where your brain will start to understand that in the last few years, you have levers to pull. One rent increase to all of your tenants, even 5%, ends up being tens of thousands in a year, possibly. You have multiple insurances to shop for better rates for. If rates drop and you do a refinance, it's not one mortgage, it's 3 or 4. What happens if you refinance 3 or 4 mortgages, do 10 rental increases, get better insurance rates on 7 properties? All of a sudden, 2,700 a month by the time year 10 happens is 10 grand a month or 12. But you haven't seen the hockey stick growth. So your brain says, nice and linear. I'm halfway through, so I must be halfway to my goal. If I double these 5 years again, I'll be making twice as much. All of that effort would not be worth $5,000 a month in cash flow. While some people could retire on that and be totally fine, it isn't what will happen. Since they started tracking rents in 1940, do you ever remember a time where rents went down?
Not me, no.
No. And in reality, rents actually don't even go up. The dollar just keeps losing so much value, it takes more rent to pay for it. You are hedged against inflation with multiple properties, all the levers to pull. In the first 5 years, you have 3 or 4 levers that don't have a big impact. After these 5 years, when you have all of these tenants in place and you have equity you can move around, you can sell for 1031, you could do a cash out, you can leave it alone like I do and let the cash flow add to your savings. It's year 5 to 10 that makes the 5 years of suck worth it. Outside of cash flow, what is another big challenge that you have in these first 5 years this time around?
I think some things that we're realizing after these first few years is that I think most of our properties, I would say, are C, maybe a little bit lower than a C in class. And we've talked about maybe it would have been better to buy in nicer areas, maybe B minus or something like that. But also, it seems like since we were investing for cash flow because of our age, that we would have needed to wait longer for the cash flow to increase in those types of neighborhoods or class of properties. And but I think we started where we needed to start, right? We started where cash flow was the thing, not necessarily appreciation, but also investing in those areas brought more challenges with the types of clients we get for our properties.
So what I'm hearing out of what you just said is that your biggest challenge in these 5 years is self-doubt. It sounds like you're not sure the strategy you chose was the right one.
Right.
Almost like the people who get that shiny object syndrome. Maybe I should flip. Maybe I should do self-storage. Maybe I should get into crypto, right? They're just the next shiny thing. You're not that bad. At least you're investing in one asset class. You'll always wonder if there was a better way to do it. Could have
Mm-hmm.
been that it was class B or higher end properties, or it could have been that it was class C in a higher cost of living area. I think the types of problems you have with tenants are different with those higher end class of properties than they are because my properties are almost all class C. And the people I know who live in class B and even A minus, the higher end stuff, I wouldn't want to rent to them. The expectations are so high. I want class C properties with tenants who will work with me on things. They understand uh, when you have something like a loose cabinet door, that doesn't mean that a contractor is going to stop everything they do on every job site and run over there to fix that. Whereas class B or class A, you might have those tenants that have higher expectations. If you did go class B, I think because of the problem is the self-doubt, you might think, what if I went at a distance? I'd have more properties, I'd have more opportunity for growth. I could be in different markets working with different property managers and maybe find the one that works out the best. Whatever you do, I think you're going to feel that and it's just going to change. And so when you make a decision, these are the markets I invest in, these are the asset class I invest in, you have to ignore the other options because there is that opportunity cost, right? I mean, if we had the crystal ball, we would all go, I wouldn't own any rentals. In 2010, I would have bought 80,000 Bitcoin and then just sat on them for 10 years. But we don't. We don't have that. We don't know what the appreciation is going to be like. You might invest in a place like for a couple of years, Texas and Florida were the booming markets. Everybody was moving there. And now it's and all the lists that comes out of the top 10 markets, local markets that have lost value, a lot of them in those areas. So there are people who were shifting their strategy based on what they thought was right instead of master one asset class, one strategy, and stick with it. You are in those first 5 years. I really hope that we have this conversation in 5 years so you can tell me the things that happened you didn't expect. Because most of the bad, negative things that you don't expect are happening now. After 5 years, when you go through an eviction, you'll be like, oh, this is how it happens. This is the timeline. This is the reserves I needed. That's no big deal. Last year, it was very stressful. In 3 or 4 years, it'll just be a part of it. And one of the other things is think of all those levers you have. A rent increase hits a lot of properties, an insurance reduction in premium hits a lot of properties. In the first 5 years, an eviction hits a recognizable percentage of your portfolio. In the next 5 years, an eviction is one property out of 10, not one out of your triplex. It's instead of being a third of your portfolio, it's a tenth. And that's a huge difference, stress wise, income wise, reserve wise, uh, your ability to be flexible to work with the situation. So there's so many angles at looking at why this first 5 years sucks. A lot of it is because you don't have a lot of levers to pull. When anything bad happens, it seems like it's huge because it can impact your entire portfolio. When somebody house hacks that first duplex and they have a tenant not paying, 100% of their rentals are not paying. That is stressful. A lot of times, a duplex is a good way to start instead of a fourplex because we can usually handle that mortgage. It's not much difference than a single family house would have been. It's not good if they don't pay, but in next year, while you have 10 rentals and you have a tenant turnover, will it feel the same as last year?
No, definitely not. Yeah, like you said, um, if everything else is full, that one vacant unit or turnover is going to be a lot easier to handle than what we went through last year. We had a few at a time. We had a couple of evictions and some large repairs that needed to be done.
And how was the stress level?
Pretty high.
Pretty high. I bet. I talked about it today on the BiggerPockets thing. My first year was so bad, I just wanted to quit. I mean, something happened in 2008 where you quit too, right? So you know that you have it in you to quit. And when those things happen in those first few years, and it's such a big impact to your portfolio, this is why so many people quit in less than 5 years. And it's the meme is so accurate. I don't know if it's a meme, but it's a cartoon of the two people digging across in the mines, and there's all the gold or the diamonds, and one is walking away and one is going, and they've got like this much left to go. Because that 4 year mark where you're at right now, it wouldn't be devastating to walk away from $2,700 a month in cash flow. But it would be devastating to walk away from what it's going to be in a couple of years. Like you've done the work. You could literally pull the Michael Zuber. You got the properties, do nothing else. Let the principal pay down happen. Let the cash flow pile up. Let the appreciation happen. And your future finances are better. I don't think that's what you'll do. It would be cool if you would take like a year in this stabilization. I see Alex and Cynthia talking in the chat that stabilizing right now would be great. But in a year, when the right deal pops up and you go to make the move and it's just rinse and repeat what you've been doing for 5 or 6 years, it gets easier. It's never easy, but it gets easier. So with that in mind, what do you think the biggest challenge is going to be in the second 5 years?
Well, for us, I think one of the challenges, maybe not a challenge, because um, the way we purchase properties would probably be the next thing to overcome or to learn. Because I think with Cynthia probably being retired and not having a W-2, we might have to try to switch over to DSCR lending. And I think seeing where those rates are in the future, the market's going to change obviously within that time. But if those types of loans are still available, I'm hopeful that we would be able to still purchase a few more properties with that.
So you have 7 properties, but not all of them have mortgages, right? You bought one or two with cash, right?
Yeah, right now there's one that is still mortgage free.
Okay. So you have 6 mortgages then? 7
Mhm. With our primary,
with your
we have
primary.
six.
So I wouldn't give up on the 3 conventional loans that you still have for 2 reasons. The first is when Cynthia retires, if there's anything related to Social Security, they can factor that into debt to income ratio. You guys have more than 2 years rental income on your tax returns. So the lenders will be able to look at the rental income of the property you're purchasing, 75% of that towards your debt to income ratio. You have a track record. You'll still have your tax returns from your business. And then there's a rumor that you might be moving to Washington because the amazingness that Washington is outside of the cities. Uh, if you move here and you purchase a property, owner occupied, duplex, triplex, fourplex, house with ADU, you can go above 10 conventional loans in your name. So even if you got 3 other properties, a house hack is not limited by the 10 loans in your name. You can continue, you can get 30 loans if you had enough 1 year occupancy to go through that. There's no limit to the owner occupied conventional loan limits. So you have a few options. DSCR is an option too to look at. There were 2 periods of time between 2020 and 2024 where DSCR rates were better than conventional. There were like windows of opportunity. Other times, most times they cost more. The down payment's usually bigger. It's not meant for a house hack, but you still have the conventional option for that. So uh, when it comes to lending, I use that Quentin Tarantino thing. The less a person makes declarative statements, the less apt they are to look foolish in retrospect.
Mhm.
Nothing is ever the same with lending. Even a lender who says we can't do something, 3 weeks later might be able to. So you'll continuously check on that. Uh, Seller financing is always an option for that too. So there is potential growth in your future. There's also the appreciation and pay down that's happening, the cash flow that's happening. So all of those things are starting to now be more and more data points to make the last 5 years worth it. So I guarantee that there is somebody that is just starting out, maybe has one rental, maybe doesn't, has just started making offers. And the challenges, like there's a reverse bell curve. The challenges happen in the first years. We make our biggest mistakes. We have the most learning to do, and the rewards are the least in the first 5 years. So you put those two things together, and it seems like it's very easy to cancel out why you're even doing this. I have a strong opinion that you continuing on with this is kind of related to who's around you, who you're talking to, who you text, who groups you're hanging out, meetups that you go to. Uh, your friends and family, you probably have the same type that I do. Investing is gambling. If you ever get a text about the plumbing leak and you have to call a plumber and send them out there, a handyman and send them out there, your friends and family at the table will say, "Oh, that's why I would never own that. I don't get interrupted." And then they answer the email from their boss or their text from their boss, and they have to go in early tomorrow to solve whatever fire that's going on in their office. But it is worth it. And it's like people say, if it wasn't hard, everybody would do it. If we didn't have these 5 years, if you could do the get rich quick scheme and be rich in a year, of course everybody would be rich. But since it's a 5 to 10 year journey and the first 5 years are going to suck, the number of people who actually do this is so small. It seems like a lot, but imagine, have you watched any of the cooking shows?
Yes.
The Chopped, Best Chef, and Make a Cake Look Like whatever. So there's thousands of those shows out now, thousands of episodes of different shows. But people can name the top 20 chefs. Like I don't even watch those shows, and I know that Gordon Ramsay is a thing and Hell's Kitchen is a thing. Just from it being out there. Real estate's very similar. We could all name Kiyosaki, Zuber, uh, McElroy, Cardone, like the people that have done it. So it seems like it's a small community, but there are millions of people that have small portfolios that we just don't realize how big a community we're in. So my opinion, get around the people who you don't need an interpreter for. When you talk about cash flow or return or tenant turnover, it doesn't stop the conversation. So you got to talk for 5 minutes about something they don't want to hear about. Versus you get around the other investor and you talk about tenant turnover, and they'll say things like, how much was the rent increase? How long was the rehab? How many tenants did you have apply? Like they actually start asking questions that apply to the conversation, making you think, like it did for me, I'm not the only one doing this, and it's possible.
Yeah, it's been super exciting being in the community. I think outside of you guys, we don't really communicate with many people, and and really all the people in the group have helped us keep moving forward. And we can see the positive aspects of what this can do for us in the nearer future. And like I've said before, I think our future is much brighter since we've been able to do this the second time.
The first time was rough for everybody. A lot of people made the adjustable rate mistake. They did the over leverage mistake. And so if you're not involved in real estate and you don't understand that people have fixed rate debt now, that lending criteria is so strong that you were thinking before we had this conversation, if Cynthia retires, you have to go DSCR. Like it is so much stricter than it was when they had the ninja loans and the adjustable rates and credit score didn't matter. And you can borrow 105% to wrap up the closing costs in your thing. It didn't matter how leveraged you were, properties always go up. Like all of those things that they were saying. To do it again, that's huge. Like especially somebody like we all that were old enough lived through it, saw how so many people lost stuff. You lost stuff and are doing it again. That's a huge accomplishment. Uh, and you know how much the first 5 years already suck.
Yeah.
But you did learn some things. You have a paid off property. You have fixed rate debt, right? You have, I think on all of them so far, you have fixed rate 30-year debt
Yes.
that have mortgages on them. That's a huge difference because the mortgage doesn't change and inflation makes the dollar change. So you get that uh, Jason Hartman thing of inflation-based debt destruction. Like eventually it'll be 2035 and you'll be paying off 2021 and 2022 prices. Like that's huge too. Rob did the underlevered mistake. It it's something I look back at and go, I did it too. I paid off a house, lost a bunch of money. I say that and I say I don't regret it. Like Frank, you guys having a paid off property, I wouldn't regret having a paid off property. That's a level of comfort and peace. I know there were people, Matt and Mike both told me in 2021, we did a video and they said the biggest mistake you're making, Dion, is you have a paid off property. Right now, interest rates are 3%. You can go borrow so much money and be ready for the next deal. And I totally could have, but I
Yeah, that
didn't. And that's why I retired.
right. And that one kind of helped us, you know, kind of like reserves because of all the repairs and stuff that we needed to go through. So that was really nice having that one paid off. Um, and having that little bit of extra cash flow helped us get through some stuff. So
There's a question from Spirited MB. I think I said the name right. Where are your properties located? And then maybe cover a little bit of how our strategies are different. Not in a bad way, just how they're different.
yeah, we're a little bit spread out. And I always speak about the fact that in the beginning of our journey, turnkeys were the way we were able to get started. And, you know, I wasn't just jumping around from state to state, but we were following turnkey deals and working with turnkey providers. So right now we have turnkeys. We have one in Gary. We have one in Illinois. We have that first triplex was a turnkey that we bought through a turnkey provider. And then we switched a little bit after those and ended up buying a duplex in Milwaukee and 3 single families in St. Louis.
The difference in how we do this is I like one market, but spread out, right? For a long time, I was in 2 counties. Now I'm hunting in 4 counties, right? I've invested in 3 now, and I've added a fourth to look for properties. So I'm spread out, but in one market. I prefer the higher cost of living market. You are in lower cost of living markets. You were able to put your money to work, get more deals going. It's a very unique in my opinion. There's not probably not unique. There's probably a lot of people do it, but you're in different markets. Uh, I don't say that it's wrong. I think you could have more negotiation power with your property managers and contractors and handymen. If you said, "Hey, I know you're in this county. I've got 3 or 4 properties. You could do all of the drywall work. You could do all of the gutter cleaning. You could do it all, whatever, to negotiate better prices." You're spread out, so you lose a little bit of negotiation power. That's not a deal breaker. You're very well diversified to where if car manufacturing moves out of one spot or something happens, nature wise, and an area goes down in value, you're very well protected against that. I can have Mount Rainier go off and my portfolio is pretty much 100% impacted. There could be one thing that hits it. So your strategy has some benefits to it. And this is the thing we say often if there's anybody that's new to the channel, if you made it this far in the video, there is no one right way to invest. There is a one right way for you. And I think listening to people like Frank on the channel here on YouTube, Old Guy REI, where he does the van confessions, uh, you don't drink much, do you? Cynthia tells me I'm wrong. Okay. All right. So
Last year was a little bit different.
I think you should time the van confessions better with when you're not sober. Get the real stories out there. Because like Josh says, thank you, Josh. And thank you, Cody, for the super chats. They are much appreciated. Tells YouTube somebody likes the content. Uh, Josh says, 2 honest guys helping the average investor. Thanks. And that's the thing. Hopefully you don't get insulted by this because this is something I say about Zuber and Matt and William Mike and myself. We're just average. There's like Zuber's a bit highly educated, but I'm just a crayon eating Marine. William Mike's a cop, right? You're a contractor. Cynthia's a teacher, so she has the brain amongst all of us. But none of us, it doesn't seem like, inherited much. None of us won the lottery or timed things perfect. I was buying properties in years where almost every year somebody was screaming, here's a reason why you should not be buying right now. Average people buying fairly average deals. Like, do you have a deal that you look at and you think, oh, that was a massive home run. I'm just making so much money. It's amazing.
Not yet.
No, I don't know that any of mine do that. Like I got one I call my best performing asset. It's my triplex. It had the best return the first year that I got it. The rents have gone up the most in that area. Like it's amazing. It's not a home run. A lot of investors in my area would have passed on it. It had kind of an okay yield when I bought it compared to what they were doing. To the rest of my portfolio, it's better. So I don't fall into the trap of you got to hit a great deal. Now, when you hit financial freedom and you retire, you might choose to only buy great deals, which means you might go 2, 3, 4 years sometimes without buying anything and then just buy a great deal. But in that growth mode, I've talked about this in a few videos. I bought 3 properties that were break even investments the year I bought them. Didn't make a penny, broke even. 10-year journey. I knew I could add a closet, turn it down into a bedroom. I knew the mushroom farm was going away. I knew the infrastructure was being changed. Investors passed on those deals and told me I was stupid. I invest in the same area. I would never buy that thing. But financial freedom happened from buying those average deals.
Yeah, it's interesting. And another thing that keeps me driven is, like you said, all of the things that we've learned, all the options we have now that we wouldn't have had before. Crazy, mindset shifts. Like you just mentioned the lottery before, was if we win the lottery, where are we going to go? Now it's, if we win the lottery, what are we going to buy? Where are
Nice.
we going to buy the next property? So I'm thankful, very thankful.
I always make it, it's a rude joke. I have friends that are couples, and one of them thinks if I win the lottery, look what I could give my spouse. And the other person in the same relationship, I know both of them, they think if I win the lottery, I wouldn't need my spouse. So you never know which part of the relationship you're in there. JR has a question here. How do you personally calculate what an leveraged position would be? I'm in the growing stage with my portfolio currently. Would you like to explain my 70-50 rule, or do you have your own version of that?
I I heard your 70-50 rule quite a few times, but not don't know it well enough to explain it well.
Okay, so
For
give your version of what is over levered.
Yeah, for us, and Cody, big Cody in the chat, I think, was sharing some information with us, and I finally figured out how levered we are. And we had a couple of paid off properties. With those, we were at about 65% levered. We did have to put a loan on one of those paid off properties to help with some expenses. So now we're at 70. I think for us, we're comfortable in that spot. I think eventually, like you and Zuber talk about in the future, maybe pay off one more and decrease the percentage of the leverage a little bit.
Very similar to what I do. So JR, you said you're in the growth phase. There's multiple phases to investing. There's like self-education phase, saving phase, growth phase, stabilization phase, uh, possibly at some point debt pay down phase. Not my thing, but could be debt pay down. It's the last thing I want to do. Or it could be sell the assets altogether and live on cash flow. Sell them and own notes. Like there's all these different stages. But I have this thing called the 70-50 rule. The 70-50 rule is 70% loan to value when you're in growth stage. So if you have $1 million worth of properties, I would want $700,000 in debt. So you guys are right about 70% right now with that debt that you added. I'd be totally comfortable. If you get this massive health concern and you just have to let everything go, you're not writing a check to lose your assets. You've got enough of a gap between 70% and 100% where you're going to pay agent fees, any kind of depreciation, recapture, capital gains tax, or anything like that. You can walk away from everything without having to write a check. That's what most of us hopefully learned from what people did in 2008 when they had to go through bankruptcy after losing their stuff. So 70% for growth phase. The reason I want 70% is if you buy it all cash, first, you're going to save up so long to buy that you're probably going to be outpaced by inflation and not be able to buy. Second, you're only going to gain appreciation on your money. That's silly. If you're at 70% loan to value, so let's say all of your properties are worth $1 million and you have $700,000 in debt, just to use round numbers, everything goes up 5%. The person who bought it in cash owns $300,000 in properties because that's how much equity that person has. Next year, they would gain $15,000 because it goes up 5%. But you have $1 million in properties. Next year, it goes up 5%. You gained $50,000. So 15 or 50. I'd rather have the 50. So I want to be levered, not over levered, so that I can walk away without writing a check if I had to. But I don't want to be under levered in growth phase because I want the appreciation while I never want to focus and pay down debt again. So not extra payments, not bi-monthly payments or any other every 2 weeks or whatever it is. No HELOC strategy to do it sooner. The tenants will pay it off over a long enough period of time. I'll have that debt pay down in growth mode while I was working. So right now, Cynthia has a job, you have your business, you guys are making money, 70% is great. When you both are not working anymore, I like the 50% loan to value because you're still getting appreciation. You still have levered depreciation, so less money paid in taxes, but you have a bigger comfort zone of rents could go down. You could have more evictions, more tenant turnovers. You're still not going back to work, right? Your ultimate failure is everyone else's day to day. So we want to avoid everyone else's day to day and having to go to work. So it's 70% in growth mode, 50% once you stabilize. And the tricky thing is, once we stabilize, it's pretty easy to be below our goal to where my next property I'm probably going to buy with my VA loan, be 100% levered on it to try to get my complete portfolio loan to value higher. So if that helps, JR, you're in growth phase, 70%. That's what I use. It sounds like Frank's target is too. And then
The other
we're not
day,
listening.
um, if it's okay if I mention that the other day you had me do an exercise to figure out how much our properties earn basically while we're sleeping. And you had me calculate um, principal pay down and appreciation. And I was surprised to see that number because in my head, just say we spent whatever $50,000 on repairs, and I'm thinking at $2,700 positive cash flow, it's going to take me a million years to get that back. But adding that profit or the increase in equity, I guess, um, helped a bit too because you have that. I think for us it was I want to say between $4,000 and $5,000 a year of extra growth, and that's kind of like dropping it in a savings account, so it's $5,000 extra to add to our cash flow to
Are you ready
help.
for your next homework session?
Yes.
It's even more challenging than that, but just as eye-opening. So the first homework session that you got from being in the course, it was I wanted you to go through and see what your principal pay down is. So every month, you look at all your mortgages and go, okay, because it changes every single month. Like one month it's $341, the next month it's $342.12. Like it literally goes up a dollar or two every single month because your loan amortization is balancing out to 50/50, and then eventually you're paying more in principal than interest. It's really cool to do that. So the longer you own a mortgage, the bigger that number is. It's cool. You just saw you said $3,000 or $4,000 more a year than you were thinking of, right? And that's real money. It's a savings account that grows without you having to actively contribute to it. But here's your thing. So you know how to run the numbers on a property. Annual profit divided by cost to acquire, pretty easy. Put all this down. I mean, not easy, but easier than people think because you've done it enough times now. I want you to do an internal rate of return. So you might have to go to AI and say, hey, explain to me like I'm five and you're a finance teacher, what's an internal rate of return? But it's going to look at so cash on cash return is good for predicting next year. Internal rate of return is terrible at looking at next year. It's used for looking at last year. An internal rate, because there's too much predictions with appreciation that you don't want to use in a calculation going forward. But it's kind of easy to go, what was the appreciation in 2023? What was the appreciation in 2024 in these markets? So you'll see your principal pay down, and internal rate of return is everything. The cash flow that you got, the principal that was paid down, how the property is appreciated. This will show you the power of leverage. Again, you're going to have a paid off property, and you're going to think, okay, I bought it for what, $68,000. We'll say you bought it for 70 grand, and it goes up 10%. You made $7,000. Great. You bought this other property for 70 grand, but you put $5,000 or $10,000 down. It also went up $7,000 because you gain the appreciation on the value of the property, not the equity that you have. And so it's called an internal rate of return. And I want to see if that's as eye-opening for you as it's been for me, because I wouldn't have known to do any of these, but every now and then I'll make a video on how did this rental property pay me? And I sit back and I go, holy crap, that's a lot of money. Harsh Reality to Fire asks, can you put a VA loan on a property you have paid off? Yes, as long as you intend to occupy it for 12 months. There's an owner-occupied requirement for VA loans. So it actually, so I have a property paid off because I did my self-funded BRRRR, and I have the VA loan available. So what I could do is take my VA loan, put it on this property, take out $700,000. That'd be cool. Then I put the $700,000 to work somewhere else, right? Or I could not touch this house. I could buy the next property with my VA loan 100% levered and start a new depreciation schedule. I have to pay taxes on income. This property is already, it's a duplex, so 50% of it is being depreciated every year. That's already happening. Taking out a loan doesn't increase my depreciation. It increases my tax obligation because I will now have more cash flow on an already existing property, then I'll put the money to work somewhere else versus borrowing money on a new asset. I am not a fan of a HELOC to buy a property or cash out refinance to buy a property, because then if some of your money didn't come from money you already had or money that's being borrowed against the new property where the new depreciation schedule starts, where the new cash flow comes from. So you can, and maybe in retirement mode, past stabilization mode, you do that and you just get a bunch of money and decrease your monthly cash flow. Great. Uh, but for me, I think it's better to use the VA loan on a new property, owner occupy it for a year, increase cash flow, new depreciation schedule, more levered depreciation. Uh, Alex is back. Nice. Question from Sid. Thanks for a prior video of cash flow you had for 10 years. Helps visualize the process. Can you talk about the cash flow at year 5 is decent for a 10-year goal? I can. So at 10 years, my cash flow was passing the 17,000, 18,000 mark. And at 5 years, I was still less than $1,000. Halfway to the goal in time was a tenth of the way to the goal in money. Hockey stick growth happens in the last end because that's where all those levers are. More properties to refinance, raise rents, 1031, a value add. In the first 5 years, if you're cash flow positive, I think you're setting yourself up fine. Because that's the thing is, that's what Curtis said. He said, I'm a third of the way to my goal in time. I'm not a third of the way to my goal in money. And that's exactly how it goes. At the 5 year point, you will not be halfway to your goal. So if you want to make 10,000 in 10 years, if you were not losing money in year 5, I think you're going to hit 10 grand, because it's the next 5 years where one rent increase hits multiple properties. One refinance can hit multiple mortgages, not one refinance, but refinancing can hit multiple mortgages. The value add opportunities there. So yeah, it's hockey stick. And that's why I made those charts. They really show it for me pretty clearly. Let me think if
Yeah,
this
I
is.
think those are really eye-opening, and I think Curtis is doing great where he's at. I think you guys had a great conversation on Mark's channel about, because he is looking at other markets. I think, well, my thought was that maybe he was um, hoping to get things moving a little faster. I think like all of us do, right? But you mentioned on one of your past videos that you're still seeing deals in your area. And if you're seeing deals in your area, he's right there with you. That he should be able to to find something in the area as well. I never would tell anybody what to do, but I think since he's done so well so far that he should keep going in his market. I think there's more room for him to get where he's going faster.
Yeah, I think, and sometimes he watches the content, so he knows we're talking about it. I think one of the issues he has is he's coming up on the year of the house hack, and he's starting to look for deals, and he's thinking, I'm not finding anything. I gave myself 12 months. I said, in 12 months, if I don't find something that makes sense, then I might look at this other market or a distance market. So if he starts now, by the end of 2026, then maybe he should be looking for another market. He's got more options than I do. Uh, he's already got the two house hacks. He's got the he's got the summers off. He can buy a place that needs work. He's already proven he can live in a place that doesn't have a shower and shower at the gym. Like he's willing to put in the work. I think he'll be good. I hope he doesn't move to a new market, but I'm just a fan of owning in a higher cost of living. Not Rob's stupid crazy high cost of living markets, but the high cost of living markets where you get more cash flow from less units. And Julie says, I'm all signed up with Hamline, priced well, but not getting many hints. Any suggestions? Send me, I put my email in the chat, Julie, send me a link to your listing and let me take a look and see if there's something that I maybe would do different, order of pictures or what you're advertising. Because it's really common for us, Julie, to think of our rentals from the owner's perspective. Age of building, square footage, and tenants don't think about any of that kind of stuff. So maybe if you send it to me, we'll take a look at it and see if there's some way to make it look different. It could just be some markets' rents are softening. Some markets have higher influx of available units. Could be, I wouldn't think it would be time of year. You, it could be time of year. If school is just ending, that might not be when people want to move, but this next month would be uh, better for you. We can look at all of those. I think we're all caught
You
up on
guys,
the questions.
I'm
Go ahead.
sorry. I was just going to say you guys helped us too with our last three listings there in St. Louis and rent softening. You brought that up. That was a big that was a big one for us because in those markets, two of the properties we had just purchased and we analyzed them at their current market rents. And then when they were ready to go up, we ended up renting them for a couple $100 less a month. They still cash flow, but the return wasn't anywhere near what we were expecting.
And you want to pay attention to the rents because real estate is local. And so with me, I'm in one market. I can fairly easily track the two new counties I'm in. Rents are pushing up because of remote work. The other two, they're not really changing. They might even go down in some of the more city areas because people don't have to live there, right? So you kind of have to know your market. Real estate is really local. And if you're in five markets, that's five kind of constant rent studies that you need to be doing. One or two might spike, one or two might flatline, and some of them could lose value. When we say rents haven't gone down since they started tracking the data, that's market wide. There isn't a time where all rents went down. There are times when major shifts happen. 2020, a ton of people said, "Oh, I want out of blue states," and they moved to red states. So there was a massive migration. There could be the car manufacturers moving away, or the dot-com crash hits Silicon Valley more than it hits like the middle of nowhere. Uh, so there could be things going on in your market that you really have to pay attention to. My market just had rent control instituted. All rents spiked up. Landlords are scared. They got all the risk now. They got tenants locked in at lower rates, so rents shot up quite a bit. I will probably use the binder strategy on every single tenant and do almost the maximum allowable increase this year at the end of the year. I wasn't going to do a rent increase this year. I was going to let them sit for because it was going to be this year the same, then next year a 5% increase. Because of that spike, I'll be doing that. But that's local. Is that happening in other markets? Maybe not. Josh, I need more leverage, but I don't sleep well at night. More leverage could help me reach Scrooge McDuck's status faster. The right amount of leverage. It's not always more, it's not always less, but it's the right one. Nice. Any closing thoughts, Frank?
Um, just again that we're even going through all the struggles so far, and some people might think they were major struggles, but it wasn't enough to, you know, make us sell everything and stop investing. So, and like I said before, we can see the positivity. You know, Cynthia reminds me constantly that even though some of the portfolio is maybe not performing right now, we have, 70% of the portfolio that is. I always tend to look at the 30%, but thankfully she um, knocks me back into reality.
It's like when you do a presentation. Have you ever heard that analogy? You
No.
do an hour presentation, 58 minutes are amazing. And a little more than halfway through, you messed up for 2 minutes, forgot where you were, forgot your train of thought, said something wrong. The next 2 weeks, you're going to think of those 2 minutes, not the 58 that went great. Real estate is the same way. Actually, it's like YouTube's the same way too. I can have on your channel, let's say you had 100 positive comments. Thanks for sharing your stuff. This is great information. So 100 people say that, right? Then one person says, I don't like the lighting in your van. What's the one comment you think about for the next 3 days? It's
Yeah,
stupid
exactly.
how our brains work that way. But yeah, you got more going right than going wrong in your portfolio. That's take that as a win.
Yeah.
Everybody on YouTube land, have a day full of amazing. Hopefully, I will see you at Bigger Pockets in October in Las Vegas. Uh, if you registered for the Bigger Pockets thing this morning, they will send you a recording of it. In the Bigger Pockets webinar is the code to get $100 off of BPCon and a free night at Caesar's Palace.
Was the free night at Caesar's Palace